Hello, we'll wait for 1 or 2 more minutes for more participants to join in. We are waiting for a few more participants to join in. The Q&A will begin at the end of the session. So first I will begin with my market commentary and outlook, and then we can take the Q&A. Yeah, so hello everyone, and a very good evening, and wishing everyone a very happy Ganesh Chaturthi. So we all have been here for the discussion about the market outlook and what should one do with the markets almost at all-time high, and how to tide through the volatility. So let me introduce myself first. I'm Nisha Harchekar. I am managing the equities department here, and I'm the fund manager. So now let's begin. So, can you see my screen? Yes. So, India has been a bright spot so far. We have seen that India has been the fastest growing large economy in Q1, with the GDP, Q1 GDP at 1 year high of 7.8%. And the GST collection of 1.5 trillion plus is now the new normal. So every month after month, we are seeing GST averaging about 1.5 trillion. So we are getting used to that kind of activity. And the economic activity is back to the pre-COVID levels. The corporate tax mop up, though it has slipped by 14%, but the total collection in Q1 is grown to 3.38%. And the manufacturing PMI is at 3-month high of 558.6%. And Moody's have raised the GDP growth forecast to 6.7% for 2023. And also, we are seeing that the corporate profit to GDP ratio is about the long term average. So, India has been a bright spot so far in the global recessionary environment, and India has been shining in that sense. And that is clearly visible with the equity market outperformance that India has seen compared to emerging markets and developed markets. So, India has done well and it has outperformed the peers. So we've seen that the GDP growth that India has seen is highest since the COVID period, and the growth that India has seen is clearly outperformed the other major markets. India GDP has grown to about 15%, while United States 6.1%, Japan about 3.4%, and so on. So India has been outperforming, and as I said that the improving macro scenario in Indian markets has been clearly reflected in the market rally and in the valuations that we are seeing in the market. So, coming to the valuation, we're seeing that the PE, the Nifty PE, which is the 1 year forward PE, is about the average line. It's averaging to about 18.4%. So this is the mean that India has seen from 2008 to 2023. So we can say that the valuation is the for the Nifty is about fair. And if we come to the mid cap and the small cap indices, the valuations are slightly above the mean level. So valuations are slightly above the mean level. For the mid and small cap counters, for the mid cap index, Nifty mid cap index, the PE, which is 1 year forward PE, is 25.3%, and for the small cap index, the PE is 15.6%. It is above the average line. So the small cap and mid cap index has been clearly the heroes and the shining stars out there, with the large cap stocks just taken a back seat with the fresh high that Nifty has taken. So the mid and the small cap counters have outperformed, which is clearly visible from the PE numbers that we are seeing. So the average for the mid and small cap P, which I was saying, is like above the average line, but it's still not at all-time high. So that is one point. So the thing I want to put here is we should be ready for some volatility now. There are some triggers and which are very important, like the US Fed pivot timing, the global liquidity tightening scenario that is going on, the US yields, which are very high, the election, 2024 and the energy prices. So, US Fed pivot, what is it? So, US Fed pivot is when the Federal Reserve reverses its existing monetary policy action. So, last Fed pivot was when the interest rates began to rise in March 2022, and the Federal Reserve started with a 25 bips rate hike, and it changed its stance from a loose monetary policy to a tight monetary policy. So that change in stance is called pivot. So after multiple rate hikes, the Federal Reserve rate, the benchmark rate now stands at 5.25 to 5.5%. So the pivot, which the market was earlier expecting to happen, was by mid 2023. So this is around the time was when the market participants in the US and in India, everyone was expecting that the pivot will happen by mid 2023, which is around this time. But if you see during the last federal meeting, uh, the stance remained hawkish. The Fed did keep the rates unchanged, but the stance was hawkish. So that is what people were not expecting. People were expecting like by mid 2023, the Fed will slowly pause and then start cutting rates. But now the expectations are that the Fed will not pivot until mid 2024. So like that is three or four more monetary policies post that. So the pivot or the change in stance by Federal Reserve is the key event that market was awaiting, and that is not happening anytime soon. So that is still like 3 quarters away, you can say that. So if you see the US yield curve, it is inverted. So the inverted yield curve, which is the 2-year yield, is more than the US 10-year yield. So what does it say? So it's the US 2-year yield is approaching the 2006 highs. So these were the highs we had seen in US 2-year yields, and we are near that highs. So whenever the US yield curve is inverted, the most inverted, we normally see recession. So the US yield curve is currently the most inverted since 1929, which was the Great Depression, and since 1979. So these were the two key periods in the US markets when the yield curve were most inverted. And we are near that level in 2023. So these circles marked are the key turning points of the market, post which the yields suggested a recession. So the yields inverted, and then uh, the US market saw recession. So if you see, the inverted yield curve could be indicating a recession. So these were the previous instances, like you can say the inflationary bust, the double dip recession, the tech bust, the housing, the COVID. So all these key points happened when the yield curve were most inverted. So the percentage indicate the percentage of the yield curve inversion. What percentage the yield curve was inverted. So we are near the 93%, you know, almost 100% when the yield curves reach, we have some kind of the other market event happening. So we need to be cautious at this time if we look at the yield matrix of the US markets. So coming to the crude oil prices, why do we say that the Fed pivot is still away? But few months back, everyone was saying that the pivot is anytime soon. The Fed will start cutting rates. So what changed in the meantime? So you can see the crude oil prices, after bottoming about 65 to $70 a barrel, is now back above 90. So it touched $94 a barrel. So if you plot the chart technically, you'll see that the crucial resistance was about $87. Now it's crossed that resistance. So that resistance is since 2025, and there were multiple instances in the past that whenever this crucial $87 or $90 resistance is crossed, the crude has rallied. The last it crossed was in 2021, and then we saw crude prices going up to 130. So currently the prices are 94 and seems to be uh, above the crucial mark of 87, 90 dollars a barrel. So if you see what is driving the rise in crude prices, so the U.S. crude oil inventory days of supply is now the lowest. The days of supply is like about 45 days only. So the inventory is very low. That is why the prices are rising. So if you come back to Indian markets, you'll see that the primary activity in India is heating, and there are so many IPOs which have come in the last 2 3 months itself. So every day we are seeing that at least two or three IPOs are hitting the market, two or three listings every day, and the promoters are like eager to have their listing in this bull scenario. So last when we saw this heated primary market activity was in 2008. When we saw the likes of Arcom, uh, it got listed, and then we had DLF listing, we had Coal India, and all those big IPOs coming during that time. So the primary market was heated at that time, and then immediately we saw a big correction. So, hinting at that primary market activity is always seen as a sign of bullishness in the economy, bullishness in the corporate fundraising activity. So this year, though the number of IPOs are not that huge, we are seeing like up till now it could be 34 or so, and the fundraise is about 24,000 crores. And the key point to note here is the fresh issue part is higher as compared to last year's. So the Indian rupee is another key element that is silently projecting something to us. So the Indian rupee has, after like 1 year of consolidation, it has breached the crucial 83 mark. So after almost 1 year, if you see, it was hovering around 80, 78, 80 levels, and now it's crossed that 83 mark, and then it's projecting that it could touch 87 anytime soon. So another key change that we have done in our portfolio and we are suggesting to the clients is that one should trim their holdings in the defense stocks as volatility will begin, and these defense stocks are as such they have rallied very very sharply. Some of them have given 2x 3x returns. So the story is sound. The fundamentals remain with solid order books, R&D investments, government support from all fronts, then import embargo, and many other export orders that these companies are getting, strong order book positions. And so these are the fundamental factors which are very well in place. And but the valuations, I would say, are at very highs, and it could be a sign that these stocks could be in some kind of a bubble territory. And the stocks have enjoyed solid returns, and so it could be a time to take partial profits. And also, with the election coming up next year, the sector is vulnerable to some extent to the changes in the government policy if there is some change in the government. So, in that sense, it is prudent to book some profits in defense stocks. So, I would say that one needs to be rational over emotional. Um don't let the FOMO take over your rational decision making. It is always advisable to take some profits in this rising market. And the second most important thing that you can do is to clean up your portfolio in this rally. So there are so many stocks in one's portfolio that one had just bought and just forgotten, or stocks which are lying in very small quantity, or your portfolio is grown to such an extent that there could be 100 or 200 holdings in your portfolio. So weed out the unwanted stocks, concentrate on the best 20 or 25 holdings that you have. And since it's a bull market and we are like at a good levels in Nifty, this is the right time to clean your portfolio. And also, I would suggest that we should have some cash in hand to buy in case there is a sharp correction in the markets. So that is it from my presentation side. We can take the Q&As. So one question I've received is advise 5 multi-bagger stocks for next 10 years. So I would like to answer in that way that at the peak of the bull market, finding a multi-bagger stock idea is difficult because most of the ideas have been sold into. So our Fintoo in-house multi-bagger pick was the entire defense pack, which was like 2 years back, and then post that we have not yet identified any multi-bagger for the next 10 years. So as I said, the valuation of the small cap and the mid cap counters have shooted to the moon, and so finding a multi-bagger stock at this point is difficult. So which sector to enter at this level? um, I would say that stick to the consumption names, though the valuations are still high, but those are the defensive bets. And pharma is one sector which could remain resilient because it is not performed in the rally, and the downside is limited in the pharma counters. So pharma is one sector that can be looked at. So so apart from the defense, what all sector that we can buy and sell at today's scenario? So the safe bets will be the defensive bets like pharma and FMCG. Then IT stocks to some extent because it's not performed in the rally, and the banking stocks, not PSU banking stocks, but private banking stocks, especially HDFC Bank because it's trading at valuations which were not seen like till 10 years ago. So the competitors in the private banking space like ICICI Bank have, you know, valuation wise, if I would say, the HDFC Bank valuations are at decent levels currently. So what is the level to re-enter the market now? So we are looking at levels of about 17,500, and we will start, but we won't wait till those levels. We will start slowly entering at every dips, deploying certain percentage of cash at every dips. So the levels which we are looking at is at least 17,500. So are the markets close to the highest heavy correction ahead? So yes, according to me, the market has made top, and heavy correction or no, time wise, I won't be able to tell. But yes, we are in for a very high volatility, and there are various indicators that I've been watching. A few of them are crude, the currency markets, the yields. All these are clearly showing that we are in for a volatility, and correction is in sight. So at least 17,500 levels is the first level that we will watch for. So, so any suggestions on railway stocks? And the similar question is view on PSU stocks. So those two will go hand in hand, because uh, PSU as a basket has rallied a lot after, especially our PM's comment on the PSU stocks in the parliament. We have seen that PSU stocks have rallied, and few of them are like touched valuations that they do not justify. Even if you see the PSU banks, the valuation that the PSU banks are now commanding is surpassed the private banks valuation. So somewhere there is some cause of concern in some kind of euphoric movement in these pockets, this PSU name pockets, and finding value there is difficult. So though you will see trading opportunities in PSU stocks, but as a long-term investments, this would not be a proper entry price for them. So if oil is going to increase, can we enter energy or HPCL, BPCL? So if oil price will go up, then stocks like Oil India and Reliance Industries tend to do well, while marketing companies like HPCL and BPCL, they suffer margin pressure. So yes, Oil India and ONGC could be considered. So should you hold or sell Tata Motors? You can continue to hold, because the fundamental picture of Tata Motor has changed very significantly since the last few years, and the cash flow situation is also improving. Though the returns, you're saying that you're sitting on profit. So if you're holding for long term, it's fine. But if you had taken Tata Motors for short term perspective or trading perspective, you can book partial profits. So view on large cap and mid cap IT stocks. The mid cap IT stock and the large cap IT stocks actually are performing in opposite directions. The larger IT stocks are have not performed, while the mid cap IT stocks, like if you say Persistent, KPIT Tech, they have done really well. So I would stick at TCS currently, uh, which is our top pick in the large cap IT space. And KPIT and persistence also remain in our portfolio, and we will continue to hold them. So view on paper stocks. So paper prices, I just read somewhere that JK paper has increased, paper prices. So though we could see the increased activity in the economy, so that generally leads to rise in the paper demand. So that ways it is good for trading and investment to some extent. But paper being a commodity, finding any great alpha in paper stocks as such will be difficult because it's a commodity stock at the end of the day. So stocks like Dream Folks, yes, Dream Folks is a monopoly business, and it's the only listed stock in this space in the airport, lounge services. So Dreamfolks is a good bet, and we have entered in small proportions in the portfolio. So yes, after the correction that the Dreamfolks prices have seen recently, it is a good bet. So on gaming stocks like Paytm and other gaming stocks and other stocks like Paytm, Nykaa, Zomato. So we don't have any view on the new age stocks currently, since the business model is like, still stabilizing for these stocks. So as such, they don't form part of our active portfolio, these three names that I've taken. So yeah, for trading, it's fine, but for investments, I would rather say that we would avoid them. So KPIT to add at this level, again, since the evaluations are at high and the stock has rallied very decently, like about 100% return since we entered in our portfolio. So entering at this level is little dicey. I would rather suggest to wait for some correction before entering. So any advisory or PMS services provided by Fintoo? So yes, Fintoo just provide advisory services in equities, and also takes care of your entire financial planning need and takes care of the entire wealth management piece. So I can ask one of our advisors to get in touch with you, and he or she can solve your queries in detail. Mm. So after a recent sell-off in HDFC Bank, is it a good time to enter or wait furthermore? So HDFC Bank, according to me, it's a good time to enter. Uh, yes, for a clear target of about 15 to 20% upside from here. So HL at this level or wait for correction? No, HL at this level or enter after the split. So defense as a overall strategy, I've mentioned that the valuation are like at highs, and most of the positives have been discounted in the current prices. So it's better to wait for some correction of at least 15% or 20% in these stocks before we enter HL. So one question is, how are IT and banking stocks looking for investments? So the IT is like the large cap IT and the mid cap IT space. So the large cap IT, we can consider TCS for long term investments, and mid cap IT where one can look at KPIT Tech, Tata Elxsi, or even Persistence, but post some correction. In the banking sector, again HDFC Bank and ICICI Bank will remain our top picks. And in the PSU banking space, we will like stay away from the PSU space right now. So view on Bajaj Finance and Bajaj Finserv not holding a positive view on these stocks right now. So one can avoid as of now, I would say. So Cochin Shipyard has corrected more than 10%. Do you suggest making any entry here, or at what good levels? So Cochin Shipyard, yeah. So correction, see, as I said, valuations are so inflated that a 5 or 10 or 15 or 20% correction from the highs will be very normal and will be very fast and quick. So after touching the all-time high of 1258, it's now about 1000. So being a high beta stock now, the defense stock is, we can say, a very high beta. So a 2 or 3% correction in market can take correction in defense stock to 10 or 15%. So 10 to 15% correction in Nifty can take the mid and the small cap stocks to down by about 25 to 30%. So uh, just a 10% correction is not good enough, I would say. One could enter at about 750 to 800 levels in for Cochin Shipyard. So suggestion for small cap stock at current level for mid time frame, I would suggest the opposite. I would suggest that take some profit off the table from the small cap counters, and don't get swayed away by emotions, seeing very sharp profits or rally in these stocks. So it's better to conserve the capital at these levels to be invested in case there is a correction. So, so Mazgaon Dock, again, the same view which I had for Cochin Shipyard. Both these names, Mazgaon Dock, Cochin Shipyard, and GRSE, all have moved very sharply hand in hand, and we should wait at least a 20%, 20 to 25% correction in these stocks to enter. So IPO, somebody asked, one can look at JSW Infrastructure IPO, which is opening on Monday. One can subscribe. View on Mahindra and Mahindra, I would suggest if you are having, you can continue to hold. And if you are looking for fresh entry, I would suggest a level of about 1450 to enter. So I think most of the queries have been answered. There were some queries related to uh, the products and services that Fintoo has to offer, and how we can manage the portfolio. There are some queries related to that. I'll suggest my team to get in touch with you individually, and one of our advisors will get in touch with you and help you out with that. So I think most of the queries have been answered, and we can call it a day. It was a pleasure interacting with you, and we hope to meet in future. We intend to have one such webinar every first week of a month, and so that we can keep you updated about the latest happenings in the market, and keep you well prepared in case we are foreseeing any major volatility in the market. So looking forward to interacting with you in the coming month, and we will keep you updated about the dates and the timing. Thank you so much.